All right, good morning, everybody. And today we are going to go right back to the basics and go over fundamental analysis. This is really one of the lessons as part of the Market Smith University. We just wanted to cover the content once again. A quick introduction here. My name is Arusha Pierce. I'm one of the product coaches, and with me today is Matthew Inouye, a fellow product coach. And today's objectives, we wanted to go over the importance of fundamental analysis to make sure we're all on the same page here, and really go over how, as a growth investor, how we use fundamental analysis. And finally, we will also highlight a few other fundamental data points that you might want to consider when you're going through some stock ideas. Now, before we get really started here, just located on the top right-hand side of your computer is the webinar panel. Whenever you have a question, just make sure you type it right in this little field here, and we will make sure to answer it during the presentation, okay? And so let's get into the importance of fundamental analysis. And so I'll start off here, Matt. So really, fundamental analysis, our goal here in this shop is to identify stocks that are just doing really well on an earnings basis. And one of the things that we like to do, because we're really combining both technicals and fundamentals, is to try to understand that story, what this company actually does, because in the end, it increases our conviction and helps us hold on to some of these positions a little bit longer.
Yeah, one of the things that a lot of times on the coaching calls, when people ask, well, why are we looking at earnings? There's this XYZ biotech company, and, their drug is going to make, change the way that we treat cancer. I basically just kind of boil it down to the point and say, if, say, you were to, invest in a company that had a lot of promise but no earnings, then if the promise doesn't fall through or, play out, I should say, then really what you're left with is a nothing. But when you have a company that's earning money, they're growing their business, their revenues are increasing, what they do, it's a solid business plan. Even if maybe a couple of quarters fall a little shy of, expectations, at the end of the day, the company is still making more money and it's becoming more valuable. And, one of the biggest things that we found is there is a direct correlation between companies that make a lot of money and the stock's going up. So, that's just one of the things to keep in mind as you go along. And it's not that it's going to be a one-to-one correlation, but, when you just take a step back over many, 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 many months, 3, 4, 5 years, if you kind of look at how the earnings progress over that 5-year span, you'll find that if the trend of the earnings is up, the market, or not the market, but the stock itself will generally go in that same, direction. So to me, that's why the fundamentals are so important. It puts sort of that backstop in place, and then you can start to do, your further in-depth analysis.
Yeah, Matt, one other thing that I was thinking is, a lot of times here we focus a lot on the technicals. We're looking at patterns, things like that, and trying to get those larger concepts down. The more you study this fundamental analysis and look at these growth companies, there are patterns there too. And so I think if you learn the larger concepts on the numbers standpoint or the story standpoint, it's amazing at how similar a lot of these things are. So when we are deciding to buy a stock, we're really using the fundamentals to help us narrow down the list of stocks to focus on. Okay, so the way we describe it is 70% of our decision is on a fundamental basis. We want to focus on those stocks that are actually doing really well on an earnings basis, and then we'll let the technicals tell us when to get in and when to get out. And here's a quote that William O'Neill had in his How to Make Money in Stocks book, and quite simply, pretty much what Matt was saying here, the percentage change in EPS is the single most important element in stock selection today. And I think we can all agree on that. You don't have to be a growth investor or a value investor. It really comes down to the earnings, whether a stock has that real chance to go on a great run. So let's get right into the current earnings. And so we took a snapshot here of current earnings from a daily chart. And this is on a quarterly basis. And as you can see here, some really large numbers here. And so that top line is the earnings. The bottom line are the sales. Okay, so ideally we want to see huge numbers on both of these lines. A lot of times I call it triple digits, all right? And you really see it in this 122%. If you start seeing numbers like that, pay close attention, because how many companies are actually doing something like this, right? It's very, very few. And so they very well could be doing something pretty special there. Now, on an annual basis, you're going to see this both on the daily and the weekly chart. And so you also, once again, want to just make sure you're getting a positive annual growth for 3 to 5 years. Like Matt was talking about, the proven track record, right? Is this company really have a great product where customers can't get enough? Are they taking that money, reinvesting into research and development, coming out with a better product?
Yeah, and one of the things that I was going to point out, and this is, this may not hold true, going forward, because you may not have another 2008 scenario for, maybe another decade. I don't know. It could happen next year. It may not. But the point is, when you look at some of these numbers and you look at how a company behaved or how they handled the '07 and '08 years, I think it actually points a lot to the management and how they're able to still drive revenue. And I guess, in a sense, it's kind of showing how inelastic the price of their service or their good is. A lot of times, when we are actually going back and researching stocks for the Growth 250, and we're fine-tuning the Growth 250 and kind of back-testing it a bit, one of the things that I noticed that Mike Webster did, and I asked him why he did it, and he said, basically Bill taught him this, but he was always looking for, if a company dipped because of any sort of larger economic reason, like in '08, then the following subsequent years, like '09 and 2010, would have to be higher than the starting point that they had in 2007. So if you kind of graphically think about, what the earnings would look like, it'd almost be like kind of like a cup and handle with a breakout on the earnings. So, the company earns $1, $2, $3, and then in '08 goes down back to $1. Then what has to happen is in '09 and 2010, it has to go to like $4 and $5 a share. And it's kind of just one of these things that, I picked up looking back at that time period. And again, you probably won't see that unless you see a huge, larger economic, recession that impacts a lot of companies. But, like Arusha said, ideally, we'd like to see a company just like in this example, which just, churns out more income, net income every single quarter or every single year, rather. But if you do see a blemish in there, just make sure that the subsequent years or the subsequent quarters come back strong enough that it kind of erases that blemish in a sense.
All right, so putting this together on the weekly chart, this is why we love this weekly chart so much. You're getting at those annual earnings and the quarterly earnings right here. So here are the quarterly earnings that we highlighted, and then here are the annual earnings. And so very quickly, you're going to be able to know whether the stock on a fundamental basis is healthy, right? So a lot of times we're going to use the technicals, see if it's setting up whether you have a chance to get into, and then you're verifying, say, hey, are these guys really earning a lot of money? And once again, here in the lower left-hand side, you're seeing that triple-digit earnings right there, where if you see that and you don't know what the company is, you want to kind of take a step back and say, okay, what are these guys actually doing? Right? What's their product? Because maybe they're just tapping into a new market where all that you're just not aware of. It's amazing how a lot of times some of these stocks will take off, and then when you look back at it, you're like, oh, why didn't I do more research on it? So get in the habit of trying to get ahead of that and do a little bit extra research before the stock goes on that run. So now one big part of fundamentals is just knowing that new product. What's new in the market? That's what the market loves, right? Especially for these growth stocks. And what have you done for me lately? That's all Wall Street is. And so a lot of it comes down to the new product, new service, new management. And so I think one of the classic examples over the last 5-6 years is Netflix. I mean, what a great stock to go back and study. Especially not just on a technical basis, just on this fundamental level. They started out as a DVD company, right? Then they went to streaming. Now they're doing original programming. And so they're constantly reinventing themselves. They're taking that money, putting it into R&D, getting better, staying ahead of the competition. Matt talked about inelasticity. Yeah, when people start getting used to this service, it's really hard to walk away from it.
Yeah, one of the things that I was kind of, I myself, believe it or not, am kind of like opposed to technology in a lot of ways. I like to keep things simple. So, the guys around here made fun of me for the longest time because I didn't have an iPhone probably for, until 2 years ago, yeah. Believe it or not. And, the thing is, it's like, I kind of sometimes get into the to the mindset of, well, who needs the new product or the new service? And as an investor, I'm really good at spotting new things, but as a consumer, I'm not so much. So, one of the things that I kind of try and, pass along to people who use MarketSmith is, try not to let your own habits dictate what you think is new. Because to me, once I got the iPhone, I was like, wow, this is so great. But, Irusha and some of the other guys have had iPhones for, years. And so they knew what was going on. And the other thing, I guess the main thing is even like Netflix. I just recently, probably about a year and a half ago, 2 years ago, started using their service. And the thing is, I had been investing in the stock for the last, probably 4 years, and trading it in and out. And it's so, one of the things is, be careful about your own prejudices and your own biases when it comes to service, products, or management, because you want to really rely on the the screeners and what the new lists are producing, whether it's in the Growth 250 or it's the William J. O'Neill screen. These are different screens that are really specifically designed to kind of pull out companies that have newer products. They're an IPO, they got a new service or something like that, and kind of put it in front of you. So just kind of be aware of that and let the data and the numbers kind of drive you to the leading ideas versus some of the personal, I guess, attachments to these products or services.
No, that's absolutely true. Removing bias is so huge. Yep. Now, one thing here also is I think really with the streaming, that was a good lesson for me. A lot of times when you see this and it just gets going, initially you're like, okay, it's called the streaming. Okay, that's probably already done in the market. It's probably captured in the move. But sometimes what we don't understand is that they're just getting started in this brand new market. And so for something like streaming, it started out just on PCs. And so the hardcore PC people were starting to discover the service. Then they moved to the iPads. They moved to the Xbox. And all of a sudden they created all these different touch points where they just opened their service to so many more people. And as a result, brought in a lot more revenue and earnings in the end, right? So sometimes it just gets a lot better. Now, another example, Chipotle. Matt, you want to talk about this one?
Well, yeah, this is actually another one that, it's kind of, you don't want to also underestimate a consumer base's demand for a certain product as well. While you may think, it's just another burrito wrapped up, living in California, there's a ton of Mexican restaurants around here, Baja Fresh, Rubio's, and so you're just thinking to yourself, what's so really new and innovative about the product? But this is where a lot of the times you can let the earnings and the revenue history kind of guide you a little bit more than your personal biases. Because this is one that, I didn't really get the story in the beginning on the first run, but once that second run happened, it was a lot clearer to me that, the customer base out there, the general public, really actually wanted this product because it was a lot better quality than the previous products that they've been introduced to. So again, it's really key to kind of, zero in on the fundamentals and the data points within the MarketSmith chart. And a lot of times try and leave your biases at the door.
So let's go into the Netflix example here. And so we went back and we grabbed a bunch of the numbers for Netflix. And it's amazing once this is the whole streaming one right here. And so you can just start seeing Netflix's earnings just consistently getting better. 4 quarters of accelerating earnings. And take a look at the 4 quarters of sales too, right? So here they are introducing a new product, so they're no longer the DVD guys, and they're getting more and more people. And so this is Netflix back in 2010, back in March of 2010, and jumping out of this base. And so this is how Netflix looked when the earnings looked like this. Okay, so huge earnings, huge sales. Sometimes it's hard to imagine that that the stock could even have more room to run. It's easy to assume that, hey, they have all these huge earnings and sales. It's already baked in. But the bottom line is that the stock was able to go up on an even larger run.
Yeah, I wanted to kind of zero it back into the fundamentals because a lot of times, when you look at it just removed and you're looking at a different, like a separate company like Netflix, a big, big corporation, a lot of times these numbers lose significance. And, I kind of take it back down to like, say you were like you owned like a donut shop or you own the bakery or something like that, and you were able to increase your revenues. Most people just strive to increase revenues, 5% a quarter, 10% a quarter. But your revenues are going, 12, 17, 19, 21, so they're accelerating. And your earnings are accelerating as well. So, every quarter you're bringing home more money. So, all of a sudden your personal paycheck, say you owned a bakery, was like $5,000 a month. Then, the next quarter you started making $7,000 a month. Then the next quarter after that, $10,000. Then the next quarter after that, you started making $12,000 a month. Now, when you put it into kind of more personal terms, you kind of realize like how significant that really is. And sometimes, sometimes just a change in point of view kind of it helps you to see how significant something like that really is. To me, that's huge. Even though it's just numbers here, if you kind of translate it into your own personal terms, if you're able to do that with your own income stream, I mean, that's huge. I mean, that's the kind of company you'd want to be in, Absolutely.
All right, and then I'll take a look at Chipotle's numbers. So as you can see here, accelerating earnings, 49, 84, 91. And then once again here, another couple of quarters of acceleration too. And, they only dipped down to 53 in between. So they are very, very consistent and just growing gangbusters here. And then take a look at those sales, just getting better and better and better.
Yeah, and here's another situation where, this is a question we get a lot of times, over the phone when we're coaching people who are, just learning the system or kind of trying to interpret what all this data means. And they're like, well, yeah, I thought you said you wanted accelerating, but it went from 49, 84, 91 down to 53, down to 33. And I say, well, yes, it wasn't like it went to 100 and then 150. That would have been terrific. But at the same point in time, let's take a step back. Most CEOs out there would absolutely love to have just 20% growth quarter over quarter. These guys hit 53 and 33%, And even more importantly than that is, there's never going to be a perfect scenario. And so what you as an investor have to do and what your job is to kind of take all that information in, weigh out the positives and the negatives. And so while I wouldn't say that this is a game, a deal killer in itself, the fact that it went from 91 to 53%, maybe they invested a lot of their, revenue into expansions or, talent, recruiting talent or whatnot. To me, what I think kind of compensates for that is the fact that, all of a sudden you have this 15, 14, 13, 16 revenues, right? The 16% growth. So it's kind of in the mid-teens. Then all of a sudden you get into the 20s, the 24s. And so the fact that, the revenues kept steady and didn't dip with the earnings, all of a sudden kind of paints slightly more, rosy picture, and it kind of helps to kind of paint that picture of the revenues are rock solid. The consumers are continuing to buy the product. But maybe they just had, a lot of expenses that quarter. They had a lot of infrastructure they had to build out or whatever it might be. So you don't want to ever look at things in just isolation and just say, oh, yeah, no good. Didn't accelerate that fourth quarter. I'm not going to buy it. You want to try and weigh out all the different factors and arrive at a decision that says, hey, you know what? Yeah, this still is intact. This is still good.
And so here's how Chipotle looked back then with these earnings, right? Accelerated at this point. This is how it looked, right? So if you assume that all these great earnings and sales were baked into the stock already, you're definitely wrong at this point. And it's amazing at how early we're seeing these stocks in the run. Now, of course, you want to make sure that the stock's breaking out powerfully and all that. But don't assume that just because you see these huge earnings and sales that the stock run is over at that point. So with that, what we wanted to do is kind of give a bonus here. We were going over these stocks with Scott O'Neill, and he asked us to just give an update on what we talked about actually last week. And Chipotle was one of the stocks here. And it was just, this is now not really even on a fundamental basis right here, but we'll talk about fundamentals right here. You can see Chipotle has continued to do really well on a fundamental basis, especially on that revenue side. Very, very consistent here. So they, it's people like me, Matt. We keep going. I keep going there all the time. right? So if it when in doubt, just go to Chipotle and a few others in the office, that's for sure. But here, what we were talking about last week as a group was we were looking at the Chipotle chart. And one kind of interesting thing here was where you had a number of stocks that were doing pretty well over the last couple of months. And here's one of the classic stocks really over the last few years. It jumped out very powerfully on an earnings report, right? Take a look at that volume. And it just kind of went sideways for weeks and weeks. So six plus weeks. And so really the question we were asking ourselves is, why is it taking so long to get going when obviously over the last few weeks, there were a number of stocks that were working pretty well. And this should be this should have been yet another stock that should have participated in the run at this point. And Matt, thoughts on this?
Well, to me, I know that going tight for like 3 weeks is positive, but that's one of the things that Scott O'Neill had brought up is you start going sideways for too long, and it's like, okay, well, why? If you've got all these great things happening, well, why isn't it going up? And to me, one of the things you always want to kind of drill down into is the only reason why a stock goes up is somebody's buying it, right? And when you look at the people who have enough money to really drive the price of a stock up, it's these major institutions, and these institutions have, maybe 50 research analysts, junior analysts researching this company, reporting back to maybe 3 or 4 head CFAs, principal analysts, and they're all looking at the numbers. They're out on the streets, counting how many people go into a Chipotle every half hour, every hour. They might be polling people, what's their average order size, how much are you spending? And they talk to the suppliers. They say, okay, how many forks did Chipotle order from you this quarter? So basically they're trying to put all this information in together from the suppliers, the vendors, how, customer base, and they're trying to paint a picture of, well, what do we think the company can do? And sometimes, if they feel like a company is going to do well, they'll continue buying the stock. But if they think maybe the valuations are, where they should be, then they'll, kind of back off on the buying. And so, that kind of is reflective here. And while we don't know if the stock is being bought or sold, the chart is telling you that really the initial demand that you saw like 6-7 weeks ago just, really kind of evaporated. And it's not to say that it's a bad stock, but it's just kind of saying, okay, now we have to wait and see how it behaves at the 50-day. If you don't see the 50-day hold, a lot of times, in our research, we have seen that a lot of times the stocks will kind of pull in just to the top of the previous base or the old pivot. That's kind of our research, 4-6 stocks out of 10, pull back into that original pivot zone. And then they go, so at this point, it's kind of like, well, you don't want to have, your whole account in there, mortgage the house, put it all in here. Oh, I love Chipotle. I love the burritos. I love the tacos. Yet they're going to expand with this, this fast food Asian style concept. There's all these reasons that you could really be, too, I guess, sold on the stock. And you don't want to be. You always want to look at things very practically. Just it's gone sideways for 5-6 weeks. That's a sign in itself, and just ever so slightly you see it kind of pulling back to the 50-day. So this is just something that Scott O'Neill had pointed out to us, just from something to study, to keep our eye out, so that we kind of build our repertoire of experience of how do stocks behave after a big move up on earnings, gapping out to new highs. But it's just one of these things we want to bring everyone's attention to, and I think that's worth noting.
Yeah, so this is how it looks right now on a daily chart. So it kind of tried to run a couple of times and reverse, came back in. So yeah, it's at a critical support level too, near the top of that gap up too that day. So it's going to be very interesting to see. Maybe that'll give us some insight on how the conditions of the overall market too.
Hey, nice segue on this one. I mean, Irush and I did a Gap Up webinar. What was it, about 3 months ago, maybe 4 months ago? This is actually a really good case study from the gap side too. How do gaps play out, especially when gaps occur on an earnings announcement and they occur to break out to, what we call clear air, where it just breaks out into a place where it hasn't been before. So I think this will be a great study going forward. Absolutely.
Yeah, and another one that Scott O'Neill brought up to us this morning was, hey, Polaris kind of looks similar to Chipotle too. Another one worth keeping an eye on to give us a little insight on the overall market. And you can see here, very strong move up out of that larger kind of cup. and then it's just kind of going sideways. So it's worth keeping an eye on to see, okay, what's actually going to happen here? Why has it taken so long for it to go? And here you go, another gap up here, and coming through. Now the 50-day has caught up to it at this point too. So you really have a couple of reasons for support at this point. So two stocks that are going to be very interesting to follow over the next few weeks. So let's put all of this into practice right here. So definitely make fundamental analysis part of your routine. It's going to really just help you understand which stocks have that potential to be game changers, right? They just might be introducing a product that's just blowing the industry away. And of course, once you start seeing those triple-digit earnings and sales, take the time to try to figure out the story. Now, there are going to be instances where you may look at it and you might not understand that whole industry. I remember the chemical industry. I tried to look at that and I started falling asleep trying to read up on all their processes and stuff like that. I have no idea how this is going to be. So you're not going to get everything, but focus on the story. Try to figure out why they are a game changer. And then always use the fundamentals to narrow down that list so you can make sure you're in fundamentally strong stocks. So let's go to the Q&A. Looks like we have a number of questions here. And so there's a great question here from Robert on IPOs. How long are you waiting for the IPOs on a fundamental history before considering it? Matt?
Yeah, that's a good question. Me personally, I really like IPOs, and it's not that I guess I should phrase it, it's not because they work so often, and actually it's the opposite. More often than not, you'll see IPOs fail. But the reason I like IPOs so much is they tend to be the new, whatever it is, new product, new service, new innovation. And so that's why I like IPOs. And really, to me, the price action of an IPO is really going to be the indicator of sort of the the fundamentals that'll be behind it. A lot of times a company will IPO and be negative. There's a couple of social media stocks like that right now that, probably just until last quarter didn't show any sort of positive quarterly growth, but the stock worked. And so to me, it's kind of, the price in a lot of cases leads the fundamentals, because remember, fundamentals only get reported once every 90 days. So a lot can happen in 90 days. Remember what I said, portfolio managers, when they run their fund, they have their senior analysts and their team of junior analysts researching all these different companies. And, in that 90 days period before the company reports their next earnings, some of these fund managers can discover something about the trends of their customers, how much they're selling, and they may start buying the stock up before the earnings is announced. And so a lot of times I tend to trade a stock, especially IPOs, just based on if they're hitting a new high, if they're breaking out of a solid base. So, in terms of, the question's kind of worded, I guess, a little interestingly, what's a possible quote-unquote investment is how the question was stated. And I say, you know what, if it continues going up, then you can figure out if you want to hold it or not. But if you buy an IPO or you decide to put money into an IPO, just be very cognizant that a lot of them don't work. So in that sense, I wouldn't consider them investment, but you just kind of, use your rules and let the trade dictate when you get in and when you get out. I don't know, Risha, do you have different thoughts?
Yeah, what I would say is that there are a lot of the ones that end up working really well and turn out to be these great companies. They had some really good fundamentals before they even went public. And so I think in the beginning you probably want to stay towards that, because Matt already mentioned here, IPOs are pretty risky. It just run an IPO screen over the last couple of years and see how many of those stocks blew up after their initial IPO base or whatever. It's staggering and how far they went down. So you definitely want to be very careful on that. And you really have to prove yourself on a risk management level. Are you good at managing risk before you start veering off to ones that might not have all the fundamentals at that point? All right. So what are your favorite screens to identify growth companies? It's funny, Matt, and you may agree with me on this. These days, there are some screens where you can accelerate earnings, accelerate sales, and stuff like that. But I guess over the years, for me, I just end up looking at a lot of stocks. So I'll pull up a large report of stocks, of hundreds of stocks, and I'll just go through them And when they're kind of setting up, if I see some, technically they're kind of looking good, and now I'm going to look at the fundamentals, and I see those triple-digit earnings and sales. That's generally how I find them these days. It's not always the accelerated earnings, but if you don't have a lot of time, I would go with that. Matt, any thoughts with this?
I mean, anyone who's ever talked to me knows that, I prefer the growth 250, but I think that's very similar to what you do, Arusha. It's a large list of stocks. The only reason that I really rely on the growth 250 is one, Mike Webster and I spent a significant amount of time researching and backtesting a lot of the screens that go into there, but it also already mimics what I used to do, which is, I think, similar to what you did, Arusha, is you just have a lot of different screens that feed into one central list, and then you just go through that list, and you just go through all the stocks. You don't research and spend a half an hour on every single stock in that list. That would just be time prohibitive. But you just go through it to see how many setups, you have. And the way I was kind of explaining it to one person is, if you go through a list of stocks, whatever it is, whether it's, great return on equity or, accelerating earnings, or you go through something like the growth 250 and you see, one setup, 10 stocks that are extended, 10 stocks that are falling apart, really you only have, one setup in 20. That's not really good. But if you're going through a list and all of a sudden you're like, wow, that looks good, and then 2 stocks later, wow, that one looks good too, and then the next stock, wow, that one looks good. All of a sudden, to me, it kind of gives you an idea of the health of the market, and that's why I like to go through larger lists. Actually, someone just wrote in about the issue of you've got too many stocks to buy. Someone was just mentioning how their breaking out today list is too large, and I say that's a high-class problem to have. I remember in '09, the Bill O'Neill screen had like 19 names, and so to me, if you've got 20 breakouts within a week, that's a good problem to have. And really, no one knows which one is going to be the one that ultimately works, but the way that Bill O'Neill explains it is you want to force feed it. So maybe you take shots at 5 or 6 or 7, and then over the next 2 weeks you watch how they behave, and you basically just whittle it down to the ones that have performed the best, the fastest, because those are showing tendencies of being a leader, quote unquote, and you kind of cut away the ones that just kind of, waddle around the breakout area. They don't really do much. Yeah, they may move higher later on down the road, but what the market's telling you at this moment with the information you have as of right now is they're just not ready to move. And so you want to be in the ones where the market is giving you that information that they are moving, they are in demand. And so it's a pretty straightforward process. Throw a wide net, whittle it down to the best possible performers. I think that kind of wraps it up. One final question. It's really kind of an easy question to answer, but someone was saying, what are some of the sectors or industry groups that you're focusing on? And while the industry group of the day may change, what I would say to anyone is, if you are familiar with the product or service, a lot of times it helps to give you a little extra conviction. So. And this is something that a lot of the portfolio managers will say here is their biggest successes have been with the stocks that they knew something about. So like the Apples, or back in the day the Lululemon, where their wives were out buying Lululemon, spending $300 in one shopping trip and going every other week, and so all of a sudden you start to add these things up. Or I think one of the portfolio managers, his kids just kept buying all these Crocs slippers, and so he had a lot of conviction on that stock. But, one of the things you'll find is that a lot of the big successes that we have, going back throughout the whole time that Bill has, had the firm and been a trader, has been in consumer-related stocks, things where you can understand it, you understand why people want it, you understand why it's better than all the other products out there, and it helps you to hold it for a bigger move. And, then you just rely on your sell rules to get out. But a lot of times those consumer places, and you look at our examples, Netflix, Chipotle, Apple, all consumer-related stocks. When you see that earnings growth, you can understand why people like it. It just makes it a little bit easier to buy and hold it. But really, again, understanding the story, adding up numbers, I think is the biggest thing. And hopefully that's a takeaway from this webinar. But I think that addresses pretty much all the questions that we had written into us. If you didn't have any something that we were able to get to, feel free to reach out to us. Number is 800-424-9033, or reach us at marketsmith.com. If you're on Facebook or Twitter, you could go ahead and search us there. But, on behalf of myself, Arusha, the entire MarketSmith education team, we'd like to thank you for joining us today, and we look forward to having you on next week.